1929, while Wall Street burned and millions watched their fortunes evaporate overnight, a small group of investors walked away not just unscathed, but wealthier than before. They weren't lucky. They weren't psychic. They had simply positioned their wealth in assets that existed outside the collapsing system. Today, as global debt reaches $280 trillion and central banks navigate the narrowest path in modern financial history, the question isn't whether you should hold cash. The question is what you should hold instead. This is the story of 7 assets that have survived every crash, every currency collapse, and every reset in modern financial history, and why the institutions that control our monetary system would prefer you never fully understood them. Let's begin with what most people believe about safety. For decades, we've been taught a simple formula. Work hard, save your money, keep it in the bank, and trust the system. It's a comfortable narrative. It's also dangerously incomplete. Because what they don't tell you is that cash itself is not a neutral store of value. It's a melting ice cube. Every year, through inflation, through monetary expansion, through the quiet mechanisms of central banking, the purchasing power of currency decays. This isn't a flaw in the system. This is the system working exactly as designed. The history of modern finance is not a story of preservation. It's a story of transfer. Wealth doesn't disappear during crashes. It moves. It flows from those who hold depreciating assets to those who hold appreciating ones. From those who trust the official narrative to those who understand the structure beneath it. And throughout history, certain assets have consistently appeared on the winning side of that transfer. These aren't speculative bets. They're not get-rich-quick schemes. They're the quiet fortresses that generational wealth has been built upon, even as empires fell and currencies collapsed around them. The first of these assets is the one that makes central bankers uncomfortable. Physical gold. Not gold ETFs, not gold certificates, not digital representations of gold sitting in a vault you'll never see. Physical gold that you can hold, that exists outside the banking system, that cannot be printed, diluted, or deleted by a keystroke. Gold has been dismissed by mainstream economists for decades. They call it a barbarous relic, an unproductive asset, a sign of paranoia. And yet, quietly, central banks have been accumulating it at rates not seen since the Cold War. In 2023 alone, global central banks added over 1,000 tons of gold to their reserves. China's central bank bought gold for 18 consecutive months. Poland doubled its gold reserves. Singapore, India, Turkey, all moving in the same direction. Why? Because behind closed doors, these institutions understand something they don't advertise to the public. When currencies fail, when debts become unpayable, when the system resets, gold remains. It has for 5,000 years. It did during the Roman debasement. It did during Weimar hyperinflation. It did during the collapse of Bretton Woods. And it will again. But gold is just the beginning. The second asset that has sheltered wealth across generations is productive land. Not suburban lots, not speculative development parcels, agricultural land that produces food, forestry land that generates timber, mineral land that holds resources beneath the surface. Land represents something unique in finance. It's a hard asset in a world of paper claims. It cannot be inflated away. It cannot be seized by a computer error. It exists in physical space, governed by property law, generating real economic output. During the Great Depression, while stocks lost 90% of their value, farmland in Iowa lost only 30%. And those who held it not only preserved wealth, but produced income throughout the crisis. When Germany's currency collapsed in the 1920s, families who owned land that grew food survived. Those who held only marks starved. Land has another quality that makes it valuable in unstable times. Governments need land to function. They need agricultural output. They need resources. And that makes land one of the few assets that holds negotiating power even in the worst scenarios. You cannot print land. You cannot create it from nothing. And in a world where everything else can be digitally manipulated, that scarcity has profound value. The third asset sits at the intersection of necessity and scarcity: energy infrastructure. Not energy stocks that trade on sentiment, not futures contracts that expire. Ownership stakes in the physical systems that generate, store, and distribute power. Wells that pump oil, pipelines that move natural gas, renewable installations that convert sun and wind into electricity. These are the arteries of modern civilization. Without energy, nothing else functions. The grocery store's empty. The hospitals close. The financial system itself shuts down. And here's what history teaches us about energy. In every crisis, energy becomes more valuable, not less. During the oil shocks of the 1970s, while inflation destroyed bond portfolios and stocks stagnated, energy assets soared. During the stagflation that followed, energy producers were among the only sectors that preserved purchasing power. Why? Because demand for energy is inelastic. People will sacrifice almost anything else before they give up heating their homes or fueling their transportation. Governments understand this, which is why energy infrastructure often receives protection even when other assets are seized or taxed heavily. The strategic importance of energy makes it almost untouchable. Now, we arrive at an asset class that most investors never consider: water rights. The legal entitlement to extract and use water from specific sources. In the Western United States, water rights can be bought, sold, and leased separately from land. In Australia, water allocations trade on specialized markets. In Chile, water rights are privatized and tradable. This might seem abstract until you understand the trajectory we're on. Global freshwater availability per capita has declined by 20% since 2000. Agricultural demand for water is rising, industrial demand is rising, and climate patterns are shifting in ways that make water supply less predictable. Michael Burry, the investor who predicted the housing crash, has been quietly positioning in water for over a decade. He's not alone. Large institutional investors have been accumulating water rights in agricultural regions, understanding that water scarcity isn't a future problem. It's a present reality that hasn't been fully priced into assets yet. Water, like energy, is non-negotiable for survival. And assets that control non-negotiable resources have a very particular value profile during times of systemic stress. The fifth asset on this list is one that requires more sophistication to hold, but its historical track record is undeniable: carefully selected fine art and antiquities. Not because they're pretty, not because they're fashionable, but because they represent portable, concentrated wealth that exists outside the financial system and has historically been exempt from capital controls and confiscation. During World War II, families fleeing Europe carried their wealth in paintings, jewelry, and rare books. These items could be transported, hidden, and later sold to rebuild lives in new countries. During the Chinese Cultural Revolution, while bank accounts were frozen and assets seized, families who had hidden imperial antiques preserved their wealth through the chaos. The art market operates on different principles than financial markets. It's less liquid, yes, but that illiquidity is paired with privacy and autonomy. A Picasso hanging on your wall doesn't appear on any bank statement. It doesn't generate reportable income. It can be moved across borders, gifted, or sold privately. And throughout history, truly exceptional pieces have appreciated even during the worst financial crises, because there will always be a small class of people with resources looking for stores of value that exist outside collapsing systems. The sixth asset is more controversial, but impossible to ignore: Bitcoin and select cryptocurrencies with proof-of-work consensus mechanisms. Not the thousands of speculative tokens, not the meme coins or venture capital pump schemes, but the small handful of cryptographic assets that represent genuinely scarce, censorship-resistant stores of value that exist entirely outside government control. Bitcoin has now survived for 16 years. It has weathered multiple 80% drawdowns. It has been declared dead by mainstream media over 400 times. And yet it keeps functioning, keeps securing itself, keeps being adopted by more users, more institutions, more nation-states. El Salvador made it legal tender. Major corporations hold it on their balance sheets. Pension funds are starting to allocate to it. Why? Because Bitcoin represents something that has never existed before in human history. A monetary asset that is provably scarce, globally accessible, and completely immune to government printing. You can't inflate Bitcoin supply. You can't confiscate it if properly stored. You can't stop someone from sending it. It exists in a realm that governments are still figuring out how to even conceptualize, let alone control. The risk profile is different from gold or land. The volatility is higher, but the underlying proposition is compelling. In a world where every major currency is being devalued by design, an asset with a hard cap of 21 million units has structural advantages that become more apparent with each round of quantitative easing. The seventh asset is perhaps the most overlooked by the general public, yet it's the one that the wealthiest families on Earth have prioritized for generations. Skills and knowledge that generate income independent of employment. The ability to provide value directly to others without needing institutional infrastructure. This could be medical skills, legal expertise, technical craftsmanship, or specialized knowledge in areas of permanent human need. During the collapse of the Soviet Union, doctors, engineers, and skilled tradespeople survived and even thrived while government bureaucrats and factory workers starved. Why? Because they could trade their skills directly for food, shelter, and other necessities. Their value wasn't dependent on the currency holding its worth or the government paying salaries. During the Argentine peso crisis, people with language skills, programming abilities, or repair expertise could earn hard currency from international clients while the domestic economy crumbled. Skills represent a unique form of wealth. They cannot be taxed until exercised. They cannot be inflated away. They cannot be confiscated. They travel with you across any border. And in times of upheaval, the ability to create value for others becomes the most liquid asset of all. Now, let's connect these pieces to the world you're living in right now. Global government debt has tripled since 2008. Central banks have expanded their balance sheets by over $20 trillion. Real interest rates, after accounting for actual inflation, have been negative for most of the past 15 years. This isn't normal. This isn't sustainable. And the people who manage the system know it. They're trapped in a corner where raising rates crashes the economy and keeping them low destroys the currency. The playbook has always been the same. When debts become unpayable, governments inflate. They print, they devalue, they transfer the burden from debtors to savers, from borrowers to those who hold cash. This has happened in ancient Rome, in revolutionary France, in Weimar Germany, in Yugoslavia, in Zimbabwe, in Venezuela. The pattern is always identical. First, the denial. Then, the money printing. Then, the loss of confidence. Then, the scramble for hard assets. The only question is timing. And here's what most people miss. You don't need to predict the exact timing to position yourself intelligently. The families who preserved wealth through the 20th century's catastrophes didn't know the exact dates of the crashes. They simply understood the structure. They held assets that couldn't be printed, that couldn't be easily confiscated, that generated real value or represented claims on real resources. They diversified not across different stocks or bonds, all denominated in the same failing currency, but across fundamentally different types of value. Some in precious metals, some in productive land, some in businesses that provided essential services, some in portable wealth that could cross borders, some in skills and knowledge. When the crash came, whenever it came, they were positioned to survive it. And more importantly, to take advantage of the opportunities that emerged on the other side. The official narrative tells you that safety means holding cash in a bank, maybe some bonds, maybe a balanced portfolio of stocks and fixed income. But look at who's telling you this. The banking system needs your deposits. The government needs you to hold its bonds. The financial industry needs you to pay fees on managed portfolios. Their incentives are not aligned with your wealth preservation. They're aligned with system preservation. And those are not the same thing. History is clear on this point. In every major financial reset, the majority loses because they followed the official advice. They held cash that evaporated. They held bonds that defaulted. They held paper claims on assets that never materialized. The minority that preserved and grew wealth did so because they held things that couldn't be manipulated by the system. Things that existed outside the system. Things that had value regardless of what any government or central bank decided to do. There's a reason why wealthy families have been moving assets into Switzerland, Singapore, and other jurisdictions with strong property rights. There's a reason why billionaires are buying ranches in New Zealand and farmland in South America. There's a reason why central banks are repatriating their gold reserves from foreign storage. There's a reason why family offices are diversifying into alternative assets at rates never seen before. They're reading the same data you can access. They're seeing the same unsustainable debt trajectories. They're watching the same political polarization and institutional fragility. And they're positioning accordingly. The uncomfortable truth is that the current system is built on a foundation that cannot hold. Not because of any conspiracy, not because of malicious intent, simply because the mathematics don't work. You cannot solve a debt problem with more debt. You cannot create prosperity by devaluing the medium of exchange. You cannot maintain confidence in institutions that consistently prioritize short-term political expediency over long-term stability. Something will give. It always does. And when it does, the assets that matter will be the ones that exist outside the system that's failing. The gold that cannot be printed. The land that produces food. The energy infrastructure that powers civilization. The water rights that control a scarce necessity. The art that concentrates wealth in portable form. The cryptographic money that exists beyond government control. The skills that create value regardless of institutional function. This isn't about pessimism. It's about pattern recognition. It's about understanding that the rules of finance are not laws of nature. They're human constructions. And human constructions fail with surprising regularity. The question isn't whether to prepare for that possibility. The question is whether you'll position yourself like the informed minority who preserve wealth across generations, or like the majority who believe the system will continue forever simply because it has continued throughout their lifetime. History suggests that the system will continue right up until the moment it doesn't. And in that moment, the only thing that matters is what you're holding when the music stops. If you want to understand wealth beyond the narratives designed to keep you compliant, beyond the advice that serves institutional interests rather than your own, consider subscribing.